How's it going, traders? I hope everybody's having a great day, and in this video I'll be showing you guys 5 steps, a step-by-step guide on how I take confirmation trades in 2022. So getting started with step 1, we have locating the zones on the higher time frame and plus the higher time frame plus 1. So first of all, you need to locate the higher time frame areas of supply and demand, and you can use my zones by becoming a YouTube or Patreon member, where basically you get all of my zones on a daily basis, and you can actually just use my zones if you're unsure of which zones to use in order to trade confirmation. So check that out. Links are in the description. You can do that, or you can always, do your own zones and do your own strategy. That's always fine as well. And you want price to be reacting off of higher time frame supply or demand. If price is inside a higher time frame plus 1 zone as well, that is a bonus. And if you see here, these are the time frames to trade. So I'm not going to go over every single one, but you can see on this graph here, we have the entry time frame. And then if you just go to the right, you can see that we have the higher time frame, which you should be using to look for confirmation. And then we have the higher time frame plus 1. So I'm not going to read everything, but you guys can just use this chart, screenshot it if you want, or write it down. It's all good to me. So next, what you want to do is to set alerts at those higher time frame zones so you can be alerted when to start looking for confirmation. And I know that this isn't a huge deal, but it is very important to automate your strategy as much as you can. So let's look at an example of how I would go about doing this. If you come to a weekly chart, and by the way, for this video, I will be using the weekly to 4-hour entry time frame combination. So the 4-hour will be my entry time frame, and the weekly time frame will be my higher time frame where I look for confirmation in. So how I would go about doing this is, if we have our weekly zone right here, which is our higher time frame zone, you should be setting an alert right before that zone so you are alerted. And what you need to do is just hit this plus icon over here a little bit before the zone and click add alert for oil. And as you can see, a little orange icon here shows up. I don't know if you guys can see that, but that is how you get alerted. So it's very important to automate your strategy. So now when price is inside of there, this is when you start to actually look for confirmation. So that now we will go to step 2. All right, so step 2, look for confirmation on the lower time frame, like I was mentioning before. So we use trend lines to see when candle breaks above or below a trend line for confirmation of that momentum shift. And you want to see candles breaking above, below the trend line to confirm that momentum has actually started to shift. So if we actually come to a GBP JPY chart here on the weekly time frame, as you can see here, the weekly is your higher time frame. So we have the weekly zone, and it was contacted right here. So if you had an alert set right here, you would have known to actually go down to your entry time frame, which is the 4-hour chart, and look at this here. So right away, I noticed as price came down into this weekly area of demand, as you can see, price came up and then down, and we actually contacted the demand right here. The first thing that I noticed was this trend line right here, like this. So we had a very clean, beautiful looking trend line, and we actually had that removed. Let's say you were looking for confirmation here, and you know that weekly demand is in control. Now you're looking for a momentum shift here on the 4-hour chart. Well, we had a very, very clear zone right here on the 4-hour chart. If we look, that is the zone that was responsible for removing that trend line. So that could have been your entry right there, and I will get in more detail in a bit. Second, we want to use opposing zones being removed for confirmation of momentum shifting in the direction you want to trade. So when an opposing supply demand area is removed, that is usually a good indication that momentum is shifting. Zones removed plus the trend line removed equals high odds setup. So what I'm trying to say is that when you get both removed, the trend line plus the zone, that is usually a higher odds situation. And in this example here on the pound yen, the reason I like this example is because it actually gave us both in this situation. We had a 4-hour supply zone right here that actually this supply zone was not removed. It was just the trend line. But if you look, this trade worked out anyways, but if this supply zone was removed as well, by peaking above it, then this would have been an even higher odds setup, but obviously this all worked out just okay. So, but there are examples of times where it will remove a trend line and a supply zone, and that is usually a very good indication that momentum is shifting. But there's nothing wrong with just using one or the other. Now, if we come over to an oil chart, on a 4-hour chart. As you can see here, let me switch to a weekly chart. We had the weekly zone being contacted right there. So we hop down to a 4-hour chart. And this is a great example of no trend line being removed because there was no ability to draw a trend line, but just a supply zone removed. So we had a supply zone right here. Let me change this. And we also had another supply zone right here as well. So if you look, price came in, reacted off of our weekly area of demand. We had our alert set right here. Price came up, broke this supply zone and this supply zone. So 2 is actually better than 1, but 1 is technically all you need. So what did we get? We had a beautiful trading opportunity right here. And this is actually a zone I pointed out in one of my last weekly Forex forecasts. So that is another great thing about watching those forecast videos. I do those every single Friday. So we had a 4-hour zone right here that worked very, very nice. So this is just an example of when zones removed are a great indication of momentum shifting. And look at that trade. It would have been absolutely beautiful. All right, step 3, we need to validate the profit margin plus structure for the stop loss. So we need to locate higher time frame opposing zones for the profit margin. Now you can use my higher time frame zones, or you find to see if there's enough profit margin for you to take the trade. I don't really know what I was writing there, but you usually want at least 3-to-1 profit margin. More is obviously better. You don't really want to have, only 1-to-1 profit margin available. You usually want more than what you want to take. So we need to locate the zone and the structure where you can place your stop loss under for protection. Before placing a trade, make sure you have a clear stop loss placement combined with enough profit margin of where that stop loss is at. And I will show you in a minute how I do that. And you can also place 2 entries where one entry is immediately after getting confirmation and the second entry at the zone or structure you're using for your stop loss placement. So let's look at an example of how I would do this. So back to the pound yen trade here. Like I always say, we reacted off of our weekly area of demand. We come down to a 4-hour chart. We had our zone right here. So your entry could have been essentially right up here. Right, this red candle right here, I know it might be hard to see. As soon as this green candle closes, you could have entered this trade with your stop loss below this structure. This is the structure that I'm referring to of where your stop loss is going to be. So now, if we come to a weekly chart here to look for profit margin, which is extremely important, and this is actually, I didn't take this exact trade, but I was in pound yen and I did a trade review on that. So there wasn't really an opposing zone here to look for profit margin, but we had essentially a weekly selling area right up here. So if we come down to a 4-hour chart and we see this 4-hour zone right here, we could probably tighten it up just a bit, and we take our risk to reward tool. If you would have entered at the top of this red candle with your stop below here, something like that, there's no signs to this, just tuck it underneath here, a little wider is not that bad. If we calculate the profit margin here, well, it didn't really give us the profit margin that we needed to enter in this specific situation. So this would have been no trade based on that. But if you remember, I said you can place 2 entries where you could have entered there. So let me actually get my tool out to show you guys. So you could have entered right where I just said at that red candle, and you could have actually entered right at this zone right here, which you could have had an entry there and there, which would have given you an average entry of about halfway through there. So let's take a look at that situation. So if we have our stop loss under here like this and our profit margin up to here, well, now we have a risk to reward ratio of 3.35 to 1. So that is a situation where that profit margin is okay. So you would have actually had to take 2 entries in this specific trade. Or you could have obviously just taken 1 down here like that, which actually gives a 6 to 1, but then you run the risk of not getting involved in the trade. So hopefully that makes sense. And like I said, if you guys have any questions at all, just please let me know in the comments down below. I have no problem going over anything that you guys have questions about. Now let's go over to oil and take a look at oil. We had our 4-hour zone right here. So now we have to validate the profit margin before taking the trade. Well, oil is a little bit of a weird situation. There's not really a zone right here, but just to be safe, you could draw a zone something like this. And that is how I would be gauging my profit margin. Obviously, if there was a clear zone up here, then we would draw that. But you pretty much want to just do that and calculate your profit margin compared to this line right here. Or if you're really, really bullish, you could also just say that the high is the profit margin, which is a little more risky, but technically for all of your take profits, it is somewhat in play where you think that all prices are going to go to all-time highs. And if you look at the long-term trend, you can really see that it's very possible to get up there. So we have our higher time frame zone. Now we go down to the entry time frame, which is the 4-hour chart. So this could have been a time where you could have entered at the break of this supply zone right here. And what you could have done is place, as price was about to break it, you could have just placed a buy order here. But the problem with that is that there was no structure here yet. So what you would have had to have done was enter rate a little bit higher. Let me mark it out on a chart. This candle right here would have been an indication that we had a supply zone right here, and you could have entered as soon as that candle closed, essentially with your stop loss under here. So let's take a look at the profit margin that was offering us. So if we entered right here with a stop loss right around here, this is clearly a profitable trade to take where it's 3-to-1. And what you would do is it would be, I believe it is a buy stop setup where you just place a limit order above here as that candle breaks. Or you could have even have waited for this zone to break, and it would have been something, it would have looked something like this, right? But there in this situation, it's not really giving us the profit margin, but that's okay. You can still enter there and then also enter at right here like this. And then your average entry would probably be something like this, and then your profit margin is completely there at least 3-to-1. So that was another great example. And as always, you can always just enter at this demand zone like this and get the most profit out of it, and that would have been a 5.2-to-1 trade. But like I said, you often sometimes price does not pull back and you don't even get involved in the trade. So if you guys have any questions about these entries, please let me know. I might have missed something and I do not mind getting back to you. All right, real quick, don't forget to like and subscribe. And if you guys have any comments down below to leave me or anything at all, just let me know in the comments down below. And if you're new, make sure to hit the subscribe button and check out my tips playlist, and always check out the YouTube Patreon membership for my zones. On to step 4. It's actually executing the trade. So we make sure that there's the structure for the stop loss and enough profit margin. We place a limit order or a stop limit order, including your stop loss. I pretty much already went over this, but like I said, you have that buy limit order that you could do where it's essentially like a breakout trade, or you just wait for your order to pull back and trigger. And like I said, you can use multiple entry points. So I'm not going to go over that again. I think you guys understand that. So you can enter right away after confirmation, or enter with 2 orders if you expect that pullback to the structure zone where your stop loss would be. So I say here, let's look at an example of a few entries, and we pretty much already did. It's pretty straightforward in my opinion. If you guys aren't understanding at all, please just don't hesitate to ask. And essentially here, if you wanted to trade the breakout of this supply zone here, your buy limit would be here and your structure would be that zone right here. Now, let's say that all of this didn't take place yet, all of this demand zone here, and this was the structure we were looking to trade. Well, you could have put your stop loss under here and entered above that trend line as price broke it, and that you could have taken profit up there. So hopefully that makes sense. That's executing the trade. I know we kind of already went over that in step 3. I'm just trying to make this video as fluid as possible. All right, the last step, which is step 5, is managing the position, and this is very important to do. So we want to use opposing higher time frame zones to take off portions of your trade. We want to set alerts where you think price could turn around and look to trim your position. You can take profit all at once or look to have multiple take profits. There's no right way to do it. There's no, absolutes. It's essentially, you should be testing things out on yourself and see what happens, and then form your own managing process. Or you can move your stop loss to break even. Once you are in the green enough, look to move your stop loss to at least break even or half risk, usually after taking your first profit off. And you can also just continue to move your stop loss in the green as price goes up. So let's look at a few examples of what I'm talking about. We're going to take a look at oil here again. Let's say your average entry was here, like we said, and your stop loss is there. Well, price is giving you, it's about 3.7. It's a little more than I thought. above there? Well, as price moved up, you could have identified opposing areas of supply. So if you come to a 4-hour chart, you can see a supply zone was right here, and you can actually see price turned around from that supply zone. So this could have been your first take profit right here, and you could have just went onto your app. It all depends. I'm not going to go over, specific details on how to take profit because my broker is probably different than yours. So what I do is I just go and I trim my position manually. I just set an alert here and then take off a portion of my position. So you could have done that. And as you can see, it would have been actually pretty bright because price pulled back significantly. So you could have also looked at this zone right here, and you could have taken a little bit of profit off there. So you could have taken off 25% right here, and then maybe another 25% up here as well. Or you can adjust these numbers as you want. You could take 50 off and 50 off, right? Or you could take full profit off here. There's no right or wrong, like I said. But the other option is to move your stop loss up as price goes up. So like I said, really quick, if you do want to take profit up here and that's your first take profit, I highly suggest taking the profit off and then at least bumping your stop loss up to break even so that it is a winning trade. Now, if you want to do the method of bumping your stop loss up, which is a method that I actually apply sometimes, we have a little bit of a zone right here. As you can see, price reacted off this supply zone and then came down and reacted off that one. So this is a great example of how you could have actually just put your stop loss underneath this zone, very well protected. And you could have gotten the rest of this trade, and hopefully price keeps going up. And then if there's a new zone formed up here, you can actually just take this stop loss and bump it up to here. That is another option. If you guys have any questions on that, please let me know. So that is how I manage my positions, and there's multiple ways to do it. Like I said, there's no right or wrong way. It all depends on what you think and your own strategy and your own testing. So definitely test everything out yourself first before making any final decisions, and there's nothing wrong with trying new things out. All right, guys, hopefully you guys found this confirmation trading video helpful. Make sure to check out the links in the description, and I hope to see you guys around the Discord group or on the weekly Forex forecast. All right, take care.